Hey guys, welcome back to the channel. So this episode is actually going to be the first in what I hope is a long series of just kind of weekly updates on what's going on in the market, what I'm doing with my dividend portfolio, I guess kind of why I do the things I do, and then answering your guys' questions as well. So I hope this is going to be more informal than the stock analyses that I've been doing for you guys, and it'll allow me to interact with you guys on a more personal basis. So in this episode, I'm going to be doing a quick portfolio overview and then going over actually a change that I made pretty recently with my investing strategy. And then we're going to be talking about Elon Musk versus California. There's a lot of different factors going on there. And there's actually probably going to be some precedent set with however this thing turns out that it'll affect a lot more than just Tesla. After that, we'll be talking about the April jobs report. It was pretty atrocious, very high unemployment, and the market actually reacted very positively to that, which will lead us into a discussion about what's actually priced into the market right now. So as I said, this is a new series. So if you enjoy seeing the series, make sure you let me know by liking the video, because it not only allows me to know your opinion and if I should keep putting these out, but it actually helps out the channel substantially, so I appreciate it. So let's jump into the portfolio overview right now. So I'm going to start from the largest to smallest allocations in my portfolio by the industry and then the holdings that I hold within it. So the largest industry in my portfolio right now is real estate. And within that, there's actually 2 holdings that I have right now, and I'm looking to eventually get this built out to 3. So right now I own Toll Brothers and Simon Property Group. Eventually I will be buying some Realty Income Corp, but it is technically overweight in my portfolio right now, so it is not investing in that right now. So the main reason real estate is my largest holding or my largest industry in my portfolio is the high dividends that it can yield. A lot of that is because of the dividend policy of REITs. REITs are kind of in their own league when it comes to the way they pay dividends, because they're legally obligated to pay out at least 90% of their taxable income in dividends. So this means that the REIT itself is not actually taxed by the government, but the dividends that they pay are not at preferred rates. This is beneficial for, I guess, everybody, because it avoids the marginal double taxation that happens on most dividends, because the company gets taxed on their earnings and then they pay out the dividends, which the investor gets taxed on. But in the case of REITs, it only gets taxed once, but because it's only taxed once, it's not at a preferred rate. So that's there's a lot of nuances to REITs, and I might dive into that in a later episode of this series, but for right now, that's probably where I'll leave it. Right now, my real estate portfolio is yielding like well over 8%, and I don't actually expect this to continue. The main reason for this is because Simon Property Group right now technically has a yield of 15%. Now, I don't expect them to make nearly as much money this year as they did last. And because of the dividend structure, they're not going to pay out, or hopefully they're not going to pay out, much more than they make. I do expect Simon Property Group's dividend to be cut, so I am going to be further diversifying it with Realty Income Corp in the future. The next highest industry is financials, which makes up 16% of my portfolio. Currently, the only holding that I have in financials is JP Morgan and Chase. This sector's been beaten down pretty badly. I think a lot of people are scared that the companies that these banks are lending to won't be able to make their payments, or they will go bankrupt. Which, if that is the case, could be a very bad sign for banks, because you need to make money on almost all of your loans to make a profit overall. Now, I like having financials as a big part of my portfolio because it's kind of removed from the general economy. But in other ways, they're really not removed at all. So they make money in a very different way than most companies. A lot of companies make money by buying something cheap, converting it, and then selling it for more than the cost that they had to pay to buy it and transform it. But in my video about JP Morgan Chase, I went into deep discussion about a couple different ways that banks make money. But in general, it's net interest margin. So basically, the difference between the rate at which the banks can borrow money and the rate that they are be able to charge companies. The next highest industry is healthcare. And in that portfolio, we have Pfizer and Johnson & Johnson currently. Now, I like healthcare because the need is not going away. No matter what happens with technology, people are always going to have health concerns, and there are going to be companies that are going to be able to profit from addressing those health concerns. Now, what I look for in healthcare companies is not those one-trick wonder biotechnology companies. A lot of those trade as almost in a similar way to options, whereas if their one product makes it, their stock will skyrocket. But if they don't, it could go to zero the next day. So I'm looking for companies that have a well-diversified portfolio of products, and Pfizer and Johnson & Johnson really do fit that mold for me. I also think something unique to the healthcare industry is that the very safe companies just happen to have been around for a very long time. In different industries like tech, you have Apple, you have Facebook, you have Microsoft, Google. These have all kind of come around, if not in the last 20 years, in the last 50 years. And a lot of the healthcare companies, the ones that are very strong, like Pfizer and Johnson & Johnson, have been around for much, much longer than that, and they've actually been powerhouses in the industry for a very long time. The next largest industry is industrials for me, set at 12%. This is composed of Raytheon Technology and Waste Management. Now in industrials, I like to be in companies that actually don't have a lot of direct competitors. So for Raytheon Technology, they're in the aerospace and defense industry. In that industry, there's only a couple main players. And the same thing with waste management. Now there are people who will deal with waste, however no one is actually competing at the same scale that waste management is right now. And I think this gives a lot of safety to their business models, because not only does someone have to overcome the products that they can produce and the services that they can produce, but they also need to overcome the economies of scale that Raytheon and Waste Management can employ to put them out of business. A lot of industrials companies have very high dividend yields, but I think in general, but also kind of specific to the industrials industry, that the yield is much less important than the safety of that dividend. I don't want to invest in a company just for 1 year where they pay me out 10% and then they cut their dividend completely the next year, because that just doesn't produce long-term cash flow. But if I can get a company that will start at 2% and then maybe over the next 5 to 10 years grow that to 3 or 4% consistently, that's what I would rather prefer. The next industry is consumer, which right now the only holding right now is Disney. I think a lot of what makes a consumer brand safe is actually the strength of that brand and how the public sees that brand. Another thing you need to look out for is future consumer preferences. So in industries like healthcare, you're always going to need Band-Aids, you're always going to need aspirin. There are essentials that people are always going to need. And consumer goods are much more likely to sway due to consumer preferences. So you don't really have to predict the future, but you just need to make sure that your company is either adapting or well positioned already for where you think preferences are going to be, or you need to be in a product that consumer preference doesn't really sway that much. And kind of piggybacking off of that, I think forward-thinking management does very, very well in consumer-driven or forward-facing businesses. Companies like Apple, Facebook, a bunch of tech companies, and consumer companies, they really need management teams that drive the company forward. Because if you stagnate, people's desires for new and improved goods don't stagnate, and that company will fall behind all their competitors. Now, the next thing in my portfolio is actually a bond holding. What I have right now in this holding is 2 different bond funds. So I have a long-term government bond fund and an emerging markets fund. Now, the reason I'm buying funds in these as opposed to individual holdings is because there is so much paperwork and legal pitfalls you can fall into with individual bond investing. It is much, much more safe to invest in bond funds. And I also like bonds because it partially insulates you from the volatility in the market. And I think the recent downturn in the market and the rebound that we've seen kind of shows us this. So as the market was falling, bonds actually rose. They almost kind of work in inverse of each other. And that's the reason why I don't have any corporate bond holdings here, other than the emerging markets exposure. So my bond exposure is in completely different markets than where my equities exposure is in. Because if I happen to have stock in a company and bond in that company, so you're investing in different instruments, but in the case that the company goes under, you're going to lose your investment on both of those. So I'm invested heavily in equities, and as a counter to that, I'm investing in government bonds and emerging market bonds. So in the case that the US economy doesn't go well, government bonds still should be paying pretty well, and emerging markets will have to pick up the slack from the US economy, and hopefully they'll negate some of that loss that the US equities drop caused. It's a pretty commonly understood thing that the older you get, the more bonds you have. And I can see this happening to me over time, but I don't know if I'll ever own more than 50% bonds and 50% equities. But that's so far in the distance, I'm not really going to worry about that now. So for the foreseeable future, it'll probably hover around 10%. Now the next industry I'm going to talk about is tech, which I also have a 10%. This consists of AT&T and Facebook. So what I really look for in tech companies is how forward-looking they are. I know I mentioned this in the consumer industry, but it's also very, very important in tech companies. And I also think tech gives me a little bit more leeway to value growth over stability. Now, I don't want it to sound like I'm not going to value stability in these companies, because if you look at my holdings, I really actually do. Facebook's got a great balance sheet, almost no debt, and AT&T has been a stable dividend producer for over 50 years. But it allows me to also get companies that don't necessarily pay a dividend now, but I think could be very good contenders in the future. Facebook kind of fits this mold for me. I think in the next 10 to 15 years, they really should be paying out a substantial dividend. I laid this kind of out in my Facebook analysis video, so go check that out if you want. And then we'll get into the last industry that I have right now. So the last industry I have is energy/utilities. And the only holding I have in this is Canadian solar. Now, I'm not a fan of investing in what I think are dying industries, which over the next 50 years, oil production should go way down, and the utilization of those products should also likewise decrease. And that's why I'm a big fan of investing in forward-looking renewable technologies like solar. Also, I like holding energy or utilities companies because they actually are pretty consistent and reliable during economic cycle downturns. Now, this downturn is kind of an anomaly because with the downturn, you also have that coupled with this price war that's happening with oil and international relations just kind of butting heads, which if that wasn't an issue, then oil prices wouldn't be, almost negative now. So I think it's important for most people to have some exposure to it, but just make sure it's a company that you understand. So that was the portfolio, guys. Let me know if you guys have any additions that you think would be a very good fit for this portfolio. And then I kind of want to get into a recent change that I made in my investment or deposit strategy. Now, in the first video I released on this channel, I outlined what my deposit strategy and investing strategy would be. So essentially, I was going to be depositing $500 every month, kind of on the first of the month. And then as I analyze stocks and as I like them, I'll be buying $250 worth of that stock every time I buy. Now, I think this creates more interesting content for you guys, but I thought over it again, and it's not only about entertainment and seeing the buy orders go through, but it's also kind of educating you guys and letting you know this is how I think investing should be done. Now, I'm not a financial expert, and anything I say shouldn't be taken as financial advice. It's just my opinion. But the way I'm switching to investing and depositing right now, I think makes most sense for the most amount of people. So, going forward, I'll be automatically investing $150 per week, and then allowing M1 Finance to invest that based on the allocations that I set in my portfolio. So what this does is it allows for more consistent dollar cost averaging, much more consistent than depositing money once a month and then always making $250 purchase amounts. And it really does take advantage of the key features that M1 Finance offers to its users. One of the coolest things about M1 Finance that most other brokers, honestly I can't even think of another broker that does it, is the way that they allow you to set up different pies. So like I mentioned with my industry overview, I have different percentages laid out for each industry that I want, and then within each of those industries, I have an allocation that I want for my money as well. So what this does is it's actually very good for people who don't watch the markets all the time. It also makes the most sense, I guess, on a long term, because as you deposit money, it will be funneled into underweight holdings. And the way that holdings get underweight is when the stock market drops. So essentially, it automatically invests in those companies whose value has dropped, which really should be giving you a better deal on that purchase. And I guess the last reason I did this is because it gets me to a point of diversification much quicker. So in my portfolio, up until I made this change, I only had like 6 or 7 holdings, and it was $250 invested in each. Now this doesn't allow me to distinguish which holdings I like more than another. It doesn't really allow me to invest in those industries like utilities or energy that are pretty small parts of my portfolio, but I still want some exposure to it. Now let's get into some news. So recently, Elon Musk has been very, very critical of government oversight and overstepping their boundaries when it comes to lockdown orders and the limitations that they're putting on people's personal freedoms. Most of this has been very, very public because Musk has been doing most of his communication through just kind of sending out a tirade of tweets. Now for some background, Tesla is located in Alameda County in California, where they're actually under a shelter in place until the end of May. This is pretty similar to my situation in Michigan because we're also under basically the same thing, but we call it a stay-at-home order through the end of the month. And essentially, he wants to open up businesses, and he thinks that the government is stomping on people's personal freedoms. So recently, he filed a lawsuit against the county, mostly because they're just not allowing him to open up production, allow people to work. And actually, shortly after that, he announced that he wants Tesla to move out of California. This got a lot of response from politicians in California and other competing areas to where Tesla may be a good prospect for. So, senators and the governor even of Texas has encouraged Tesla to come to their state, and also Nevada is another key player. And if this situation couldn't get any weirder, Elon Musk basically volunteered to be arrested. Now I know that sounds strange, but let me just take it from his tweet that he released. So Elon Musk said on May 11th, quote, "Tesla is restarting production today against Alameda County rules. I will be on the line with everyone else. If anyone is arrested, I ask that it only be me." And here's the thing. Tesla shareholders almost kind of expect this to happen now with Elon Musk. When you invest in Tesla, you know what you're getting with Elon. So it's not like it's going to send the stock market crashing if he kind of goes off and really does express himself like this. But I think this leads to a couple different points. People need to understand that this shutdown is hurting economies very badly. Not only is it going to be disrupting supply chains, not only is it disincentivizing people from spending money because they're scared of another shutdown, but it's also going to be drastically reducing the money that local and state governments get. Because if the companies don't make money during this year, they will not be paying income taxes. It's also interesting because it brings up a conversation of business-friendly states versus non-business-friendly states like California. So California has very high state income taxes, where other states like Texas, where Tesla's considering moving, has literally 0 state income taxes. Now they make money through other avenues, but for a corporation moving there, that's a really big factor in why you would want to. And it'll be interesting to see if this sets a precedent. So if Tesla does move out of California, it does kind of spur other companies to consider maybe moving their headquarters to a more business-friendly state. Over time, we've seen people moving from states like California to business-friendly states like Texas. And something like this that's so public could just spur more businesses to follow suit if Tesla does end up moving. Also this week, we got the April jobs report. So let's just kind of go over and highlight some of the main key points of this report. So in April, the United States lost 20.5 million jobs, which is by far the biggest drop since 1939 when they started tracking this metric. And also, when you include March's 870,000 jobs that they lost, these double the financial crisis. So in 2 months, the United States economy has lost twice as many jobs as the most serious financial crisis that most of us have ever experienced. Also, the unemployment rate rose to 14.7%, which is the highest since tracking started in 1948. Now, the Great Depression was estimated to have peaked at 25%, and this actually was a lot worse than what we're facing right now. A lot of the unemployment right now is actually temporary, whereas the Great Depression, there was real reason for these people to actually have lost their jobs. For example, of the 23 million who were unemployed in April, 18 million of those were reportedly temporary out of work. Now, these could actually be temporary outages, but there is a case to be made that these people who call themselves temporary won't actually have a job to go back to after this is all done. Many jobs won't rebound quickly, including like hospitality, travel, and leisure jobs. And also, due to some improved automation and efficiency in businesses, they're just not going to need as many employees. Once they've really had to button down and cut costs, they're going to realize that, hey, we were paying people that we really didn't need. So these people probably won't get their jobs back once it's all said and done. And also something interesting in this was only 51% of people above 16-year-old are employed currently. And that really just shows the difference between the unemployment rate and the percentage of people that don't have jobs. The difference is the people who have completely dropped out of the workforce. So that means they're not even looking for new jobs. And how did the markets respond to the jobs report? Well, it was actually a really positive day. The Dow finished up 2%. And this kind of leads us to ask, what exactly is priced in? Because with bad news like this, you would expect the market to drop. So year to date, the Dow is down 17%, the S&P 500 is down 12%, and the Nasdaq is down less than 1% year to date. And with those numbers in the back of our mind, what exactly has happened this year? So, obviously the coronavirus happened, but the market is forward-looking. So the only thing that really should affect the market is effects that will be impacting these companies in the future. So, travel's been hurt. And honestly, it probably won't rebound to the same levels for a couple years. I think people are much less likely to want to go on cruises or to go on big family vacations with a lot of people, because until we get a vaccine, a lot of people won't feel comfortable going out into large open areas with a lot of people, especially if they have loved ones who are elderly or they're immunocompromised, because those are the people who are the highest risk for this. And also, personal finances have been hurt very bad. This is a result of many people being out of work, which leads to less spending, higher defaults on loans. So that's why I'm not really interested in mortgage REITs, because I think the amount of defaults on mortgages could be very high. Now, banks are somewhat insulated from this because they usually sell a lot of their mortgages to different investors like mortgage REITs. So financials shouldn't get the brunt of all this force. It's really going to be those mortgage REITs, which is why I'm staying away. And honestly, it's just not worth it for a lot of people to return to work. Many people, especially those who are making minimum wage or close to minimum wage, are getting paid more right now than they ever have in their life. For example, in my state, no matter how much money you were making before the corona, and you're now currently unemployed, you're getting $170 for unemployment, and then you're also getting that additional $600 per week from the federal government. That's over $700 just for doing nothing. Now, if you consider that many people are working minimum wage jobs, or maybe around $10 an hour, they should be making theoretically around $400 a week. But now that they've lost their jobs, they're actually making over $700. And I think this will actually make people much less likely to even want to return to work, as long as the government is still taking care of them. Also this year, supply chains have been hurt really badly. A lot of people will say, oh no, the manufacturing is open in China right now, so our supply chain really shouldn't be hurt that bad. But if you look on the graph on your screen right now, this is a report by McKinsey. This kind of shows the delay between when manufacturing stops and when these different industries are actually going to see the impact of that manufacturing delay. So in industries like pharmaceuticals, where they usually keep a lot of inventory on hand, they're not going to see the effect until late this year. But other industries like automotive, retail, and consumer businesses will see in the next month or 2 months. So really, we won't even be able to assess the full scope of the damage to our supply chain for at least the next year, because all of the inventory backlogs are keeping us afloat for now. But when those backlogs are depleted, you're going to have some issues fulfilling all the customer demands. Now, when we entered 2019, the market was really priced to perfection. We just came off a year in 2019 when the stock market performed really, really well, much higher than average. And this led to higher forward PE ratios than we have historically seen on average. So let's think of a hypothetical right now. If all of this news broke at the beginning of the year, maybe over the course of a week, that all of this was coming, that the government was going to shut down businesses for months, and the global economy was going to be thrown into a state of disarray, when we're at a point where we're 2 months into this thing, and we still can't reasonably predict where we're going to be a year or two from now, how much do you think the markets would fall? If it were me, I would put my money on, I don't know, maybe 30 to 40%. And that's what we did see when the stock market crashed. But since then, we've only continued to see bad news, and the stock market has rose considerably. What I think this is leading us to is the market is pricing in basically a perfect rebound, like a sharp V-shaped recovery. In general, people must be expecting very little long-term disruption, and I just don't think that's realistic. So for the most part, I've stopped most of my investings. I've kept the systematic deposits into this account, and I've kept my systematic 401k contributions. But anything in addition to that, I'm kind of just building out a cash position. And in this episode, we don't necessarily have a question from one of the viewers, but there was a comment that I kind of wanted to respond to on one of my old videos. Now, this wasn't submitted as a question, so I'm not going to be showing the user's name because they didn't intend it to be used like this. But I felt like it was worth talking about. So here's the comment. Hey guys, I hope you can mention Simon Property Group, biggest U.S. mall owner. They're planning on reopening 49 malls for their own profits. They're encouraging people to stop social distancing instead of slowing the spread. They refuse to pay all their employees. They want your money. They've been struggling as it is, and now they need your money even more, even if it's far too soon. And this isn't really about this comment in particular, but it's something that I see a lot. I think people are too quick in general to attribute negative motives to companies. Companies are just a collection of people there for a purpose. Now, even if that purpose is making money, collectively the business shouldn't make decisions that the individuals wouldn't. Now, Simon Property Groups is only opening their malls in areas that are not heavily affected by this coronavirus outbreak. They're not going against local guidelines and are actually implementing procedures to encourage social distancing within their malls. Also, to address the payment issue, like I mentioned before, a lot of these employees are probably making pretty close to minimum wage. These are retail workers, a lot of them are probably high school, college students, and those people are probably receiving more money now from the federal government than they ever did from the retailers that they work for. And just because businesses are formed to make money doesn't mean everything they do is about greed. Because this is the livelihood of a lot of people. Many people may not have experience with owning a business or know anyone whose business is on the brink of failure, but it really is a super emotional and personal problem. These people take it hard. It's a much harder issue to lose something that you've built for years than it is to just lose your current income from losing your job. So I guess the point that I want to get across is not everything is so one-dimensional. Not all companies are just after your money. And just because they're a big company doesn't mean that all their actions are evil. So that was this week's episode of this series, guys. Let me know what you think, any comments you have, or suggestions that you guys have for future videos. Also, if you have any questions, I really would like submissions for the next video, so I have a little bit more to work off of than just some comment. I plan on releasing 2 videos a week, one of this series, and then 1 stock analysis like I have been. So you won't be missing out on any of that content, but this is just going to be more for you guys. If you guys like the video, make sure to like the video, share with your friends, and subscribe to the channel so you guys don't miss an episode of this in the future. And I will see you guys in the next video.